You should be allocating money to certain securities. You should be assessing your risk. We're going to talk all about that with Daniel Akinwunmi, who, of course, runs the global fixed income trading desk over at First Island Asset Management. You're welcome, Daniel. Good to see you, man. Daniel, it's a new month, and I want to start off with talking about a balanced portfolio. I want you to preach the gospel of a balanced portfolio to the congregation and the people about why it is important.
All right then.
You can use a pastor voice if you want.
All right then, let's talk about what a balanced portfolio is.
Yes.
Like the word itself, balanced. Your portfolio needs to be apportioned evenly to a number of assets. So let's say we have chips here, for example. And
you're making me regret I didn't get those chips.
and then this table is like your financial life.
Yes.
And there are chips here. These chips are opportunities for you to make money. So you don't want all your chips in one basket.
Exactly.
If you have all your chips in one basket, that means you're taking just one bet. And that limits you to just one outcome. And when that outcome is not met, and then things do not go how you expect, then that is a bad investment. But then if you spread these chips across several assets, for example, you have them in bonds, equities, you have them in some FX derivative instruments or any other alternative assets, you've created opportunities for yourself to make money. You are not just waiting on an outcome now, you're waiting on opportunities. That way your portfolio is balanced. So let's say these assets are like, okay, let's say this is a plane,
right?
And you have multiple engines.
So
when one fails,
you have another.
Exactly. So that's the essence of balancing your portfolio. So there's a theory that says, I think it's the portfolio management theory. It says the sum of the risk of a portfolio is not in the parts, but in how the parts relate to each other. And that's necessary because if you have bonds, when interest rates rise, bonds react to interest rates.
That's right.
Prices crash. You have to compensate the buyer of the bond with a good yield. For example, if interest rates rise as well, it could affect equities. So the relation of these parts to how the market moves determines your balanced portfolio.
Yeah. Do you remember, I think it was Avengers Infinity War, the scene where Thanos first kidnaps, he adopted Gamora after destroying the planet. And then he has that big blade and he says, perfectly balanced as all things should.
Yes.
We have that clip. Can we share that clip about balance of Thanos a few times, please?
Balanced, as all things should be. Perfectly balanced, as all things should be. Perfectly balanced, as all things should be. Perfectly balanced, as all things.
We should play that over and over again. Perfectly balanced as all things should be.